Hello traders, welcome back to yet another episode of the free Smart Money Concepts course. By now, we have covered a lot of important topics in SMC, from structure mapping, liquidity, inducements to order flows and order blocks. In this episode, we will focus our attention on one of the common manipulation methods in the market. Market manipulation is the cause for losses of many retail traders, but still, there are some proactive traders who trade with this manipulation and they grow their small accounts with the smart money. If you know how the market behaves, you can easily identify the possible manipulation areas for taking advantage of. The manipulation concept that we will discuss is known as the institutional candle or the institutional funding candle or IFC for short. For beginners, the institutional candle is an outstanding concept associated with the market liquidity and price action. In addition, it is also a standalone powerful trading strategy that is followed by many SMC traders and price action traders. So in this video, we will talk about what an institutional candle is and why do these IFC candles form. We will also find reasons as to why these IFC candles work in the markets and why is it important for traders. And finally, we will also learn how to take trades using this concept. So make sure to watch the video till the end to get the complete understanding of the entire concept. So let's get started. The institutional funding candles are represented as the last opposing single or multiple close candles before the market forms a strong directional move. Those late buying or selling candles with one or more candlesticks within them which runs out of liquidity before heading in the intended direction are referred to as institutional funding candles. These candles simply indicate that the institutions sell before buying and buy before selling. And that is the reason why these institutional candles are also called banker's candle. So it is one of the most popular smart money trading concept out there. Basically, it is the manipulation phase, or we can visualize it as a tricky area where the big banks and institutions manipulate the market for liquidity. So if you remember, I have already talked about the AMD concept of liquidity in the episode about inducements. You can go back and watch that video to get a detailed understanding about the topic. But to brush things up, the AMD concept or accumulation, manipulation, distribution is a three-step process which involves hunting the retailer liquidity in the market by inducing these ill-informed traders to buy or sell at the wrong place at the wrong time in the wrong direction. This IFC concept is one of the popular manipulation techniques used to absorb the retail liquidity. You can easily identify this institutional candlestick pattern in charts with your naked eye. You don't really need any additional indicator to look for it. So if you want a simple hack to identify these institutional candles, then follow this idea. So when you are looking at the chart for institutional candles, give extra attention to the body of the candles and not the wicks. The majority of the volume is held by the body and big players are trading there. Wicks are not so much important as retail traders are trading there. Now you may ask me, why do these institutional candles form? The one word answer is obviously liquidity sweep. But for the sake of better understanding, let's just take the longer route. So whenever there is a buyer in the market, there must be a seller. So there must be somebody on the other side of the market to take the trade. This is true for all liquid markets and assets. And that is the reason why market prices moves, and this is where the institutional funding candle comes to play as it acts as a fishing worm of the smart money to grab retail traders' liquidity. Generally, from a retailer point of view, the stop loss is placed above the swing high for a short trade position and they will set their stop loss below the swing low for buy orders. Now, when institutions and big banks wants to sell, they will need more buyers. It's obvious, right? So what will they do? Keep in mind that these big players are looking to sell at higher prices, so they will require more buyers to buy from them at higher valuations. Most of the time, their modus operandi is the same. Initially, they breach the immediate swing high level with a big bullish candle with little or no wick. On different time frames, you might see different scenarios. You might see one big candle push in the 1 hour time frame, but on the 15-minute or 5-minute time frame on the same chart, you'll be able to see multiple candles push through above the highs. Remember that in the formation of institutional candles, the number of candles is not important. It may be one or more. But the crucial thing is the intention of these candles or the push, which is actually to take out the liquidity. Now, the stop losses of all the early sellers are triggered by this push, which is placed above the high. We know for a fact that the seller stop losses are actually buyback orders. Besides this, the buy limit orders of breakout traders also exist above the high level. The institutional candles will also trigger these buyers' buy limit orders deliberately. This is the manipulation step. Further, the institutions will grab all the unwilling and willing buy orders as liquidity to sell their positions at higher valuations, and once the liquidity is absorbed, their intended bearish market movement will start. The same case happens during a bullish price move. So the intention of the big institutions is to buy at lower prices. So they will require a lot of sellers to sell at lower valuations, which will become their liquidity. And in order to create this liquidity, the big players will manipulate prices. The price will breach the immediate low or the support level with a big bearish candle with little or no wick. And as mentioned earlier, it can be multiple candles as well. It is not really the number of candles that matters, but it is the intention of these candles or the push. The stop losses of early buyers are triggered due to this price push, which were placed below the lows or the minor support. We know that the buyer stop losses are actually sell orders. Besides this, the willing sell orders of breakout traders also exist below the support level, which are also triggered in the process. And once the institution grabs all the unwilling and willing sell orders as liquidity, their intended upward movement will start. So the agenda of institutional funding candle is to take out or sweep the liquidity above or below the immediate resistance or support lines respectively. Now you can ask me, why do these institutional candles actually work in the market? Now the strong reason why institutional funding candles work in the market is because these are the drawdown or loss of the smart money. I know you are confused, but let me explain. If the big institution wants to buy at lower valuation, they will need more sellers who would sell at lower prices. For generating enough liquidity, they will manipulate the prices. In this case, they will create a single bearish candle or a group of candles below the immediate low or the support level. This means the institutions are actually selling here, but their real intention is to buy. But they sell initially to trap the retail traders in their trades so that they can start using the retail orders to buy at lower prices. And when the price returns back to the previous support level, they would exit their short positions on a break even or on a small loss. And as you can guess, these institutions won't take such unnecessary positions and losses unless they want to make a much bigger gain. So keep in mind that usually when the price comes back to the manipulation zone, smart money would close their counter order with a small loss or break even. As they mitigate their position, these are the best places to take a trade and make some profits by following the footprints of the smart money. Now let us discuss what makes institutional candles important. Institutional candle helps you to determine order flow and market structure. Yes, you heard it right. We know what an order flow is. So a bullish order flow is the last selling move before a buy on a bullish market structure, and a bearish order flow is the last buying move before a sell in case of a bearish trend. Now look at how institution candles form. It follows the AMD criteria. This means the manipulation move, which is the IFC, will act as the order flow since it is the price move against the major trend structure. Now IFC can also be used to determine market structures. This is because institutional candles usually form the extreme highs and lows in a price move before the actual distribution in prices. These highs and lows can act as swing highs and swing lows, which are reference points for mapping the market structure. In addition to this, IFC is also a popular trade entry strategy. You can think of trade setups in the dominant trend direction, and the trade entry orders can be placed after the last price push up or push down beyond the zone, which is an important strategy that many traders follow. Actually, institutional candles forms swing highs or swing lows, so there are high chances that the market will never violate or break beneath the low of the last down close candles in a bullish market, and likewise, price will never violate and break above the last up close candles during a bearish trend. In addition to this, if you have watched my videos on liquidity, that is both major and minor liquidity, and if you have done analysis on the charts, then you might have come across innumerable situations of liquidity manipulations taking place in different locations and in different scenarios. These liquidity manipulations could be near equal highs and equal lows, near supports and resistances, during consolidation breakouts, trendline breakouts, during pattern formations, and so on. And on most cases, within these manipulations, you can spot institutional funding candles which goes deeper to grab the retailer orders. So what I mean to say is that IFC is a very common manipulation type that you can find on the charts. Now let us learn in detail as to how to trade with these institutional funding candles. So first of all, you will have to mark up your major swing points that are formed by the institutional funding candles. Remember that in the upward moving market, the last down close candles are usually respected, while the last up close candles are respected in the bearish trending markets. In case if the market is in a consolidation period, then both these types of institutional candles are respected. Once you have identified the IFC candles, you need to mark the IFC range. For this, you need to select the Fibonacci tool from the toolbar and then select the highest and lowest points in the institutional candles. So the idea is to start plotting the Fibonacci retracement from the origin of the IFC candles. For bearish candles, start drawing from the highest to lowest point, and for bullish institutional candles, begin from the lowest point and follow through to the highest point. The Fibonacci retracement levels will be automatically plotted, but we only require the 0%, 50% and 100% levels. You can go to the Fib settings and change it accordingly. Now, even though you can execute a trade anywhere within the range of the institutional candles, it is mostly preferred to enter a trade either near the opening price of the institutional candles or at the 50% of the push. So you can trade within the Fib 100% to Fib 50% levels. This is your tradable zone. Now, where to take a trade entry is entirely up to you, depending on whether you are aggressive or conservative in your approach. But let me tell you, if you plan to take trades at 50% of the institutional candles, then you might miss some of your entries because price never always returns to the 50% level. But on the upside, if your limit order or market order is executed at 50% level, then you will definitely get a better reward to risk ratio. One additional thing you can do is you can use the Fibonacci retracement tool once again and select the Fib 1 and Fib 0.5 levels. This will generate another Fibonacci level at the 50% of our entry zone. This can further improve our chances of getting into most of the trade opportunities without having to take much risks. When it comes to stop loss setting, your stop loss should be placed above the highs of the institutional candles for the sell orders, and it should be placed below the low of the down closed institutional candles for buy orders. You can even place your stop loss above or below the institutional candle's body or wick. But I personally prefer to place my stop loss above or below the wick. This is the best and safest place to place your stop loss. Now let's talk about the targets. Your take profits should be placed at the next area of interest or price of interest. It could be the next high or low, support or resistance, supply or demand zone, equal highs or equal lows, where ample liquidity exists to drive the market to the opposite direction. You can also place your take profits by analyzing the higher time frames. I think that as a beginner to SMC concepts, a bigger win rate is more important than the large reward to risk ratio. So you should cut over expectations and place your targets at a specific logical area and be consistent with it. And always try to improve your entries, thereby you can maximize your rewards. Now let's take an example to understand the concepts even better. In this case, the price is trading within a range. In such cases, both the up closed and down closed institutional candles are usually respected by prices. Now as you can see, price formed equal lows which I have marked here, and then it consolidated for a while. Then the price moved lower and it broke below the equal lows with candles having deep wicks to sweep the liquidity below this level. And once the liquidity was absorbed, the price moved swiftly, creating imbalances or fair value gaps on the way up. These imbalance formations are very important. It gives a reason for the price to return back and fill the inefficiency that was created. To know more about fair value gaps or imbalances, you can watch my video on the same topic. Anyways, when the price starts to move higher, we can identify the manipulation candles. In this scenario, these are the last down close candles. I have marked these candles. Now I have to identify the tradable IFC range. For this, bring up the Fibonacci retracement tool and select the highest point in the IFC candles, and then drag the cursor and select the lowest point in the institutional candles. This will give you the IFC range. As I have mentioned before, when price returns back to this range after mitigating the imbalance, we will look for long trading opportunities from Fib 1 or Fib 0.5 levels. If you want, you can also draw another Fibonacci retracement between the Fib 1 and Fib 0.5 levels to obtain another 50% level at the midpoint of these two levels, which will give a higher probability that your buy limit orders will get executed, and this intermediate level will provide a better risk to reward than the Fib 100% level. Now let us observe what the market did. The market moved higher, broke above the consolidation, after which it reversed, took a short reaction, and once again break below the resistance turn support level. Further, price consolidated near the resistance area where it formed equal highs. I have marked this level. Now the price made a build up and eventually break above the equal high level to sweep the liquidity above it. After the liquidity hunt, price returned lower. This manipulation was in form of a level breakout following a consolidation. After the manipulation, price declined lower swiftly, creating an imbalance or a fair value gap. This is a classic case of AMD or power of 3 concept. Also, this imbalance or inefficiency is a crucial part of the overall concept because it gives price a strong reason to return back and fill the inefficiency in prices. The manipulation move or the liquidity grab was done by institutional candles. In this case, the last up close candles are our IFC candles. I have marked these institutional candles here. Now we have to mark the tradable IFC range using Fibonacci tool. For this, bring up the Fibonacci retracement tool and first select the lowest point of the IFC candles and then select the highest point of the institutional candles. Our tradable zone is between Fib 1 and Fib 0.5 levels. You can also mark the intermediate level between Fib 1 and Fib 0.5 levels for getting good results. So the overall idea is to place sell limit orders at any of the mentioned Fibonacci levels when the price returns to fill the inefficiency, and there are very high chances that the price will tap into this Fibonacci range and our sell orders will get executed. Now let's see how the trade has turned out in both the cases. So the price returned to our bullish trade setup. All the buy limit orders between Fib 1 and Fib 0.5 levels are executed. You can set your stop loss below the low of the IFC range. For target placement, you can choose this recent swing low level as your first take profit level. You can also choose the resistance level for target, but the probability of price reaching this level is low. And as you can see, the price moved higher and attained our first target. But the price did not move all the way up. Instead, the price reversed once again and sharply moved lower. Once an IFC range is tested, it is not useful anymore. The price breaks through all these ranges. Keep in mind that our bearish trade setup is still active, and after a while, price reversed sharply and it started to rise again. It came back to fill the price inefficiency and it tested all the sell limit orders placed between Fib 1 and Fib 0.5 levels. In this case, our stop loss can be placed above the high of the IFC candle. Our target can be set as the previous low formed. And as you can see, the price moved lower and hit our take profit level. I hope things are clear now. So you have to identify equal lows, equal highs, support resistance levels where possible manipulations may occur and the institutional candles might form. Then you have to mark up the candles. It might be one candle in the higher time frame and multiple candles in the lower time frame. Now you know how to spot this smart money manipulation. Institutional candle is an advanced price action trading concept also. So make sure you learn this concept properly, backtest this strategy in multiple charts, and improvise consistently in paper trading. And when you get positive results, then only you should implement it in your live trading. So if you have come this far, thank you for watching this video. I hope you have found this video informative, and if it was useful, please make sure to like and share this video with your friends and fellow traders. And also don't forget to hit the subscribe button and turn on the notifications to stay updated on our latest videos. We value your feedbacks and suggestions, so please leave your comments below and let us know what topics you would like us to cover in our future videos. I appreciate your support and I look forward to seeing you in the next episode. Till then, bye.